Always forget to unmute. Very important to unmute. Anyway, hi. How is everybody doing out there? It's Thursday afternoon here in the very chilly Orlando, Florida, and 7:30 p.m. in the UK, wherever you are in the world. Welcome to the Thursday evening, or day, or morning financial thing live stream. Hope you're having a really good week. It has been an interesting week. We got a lot to talk about today with a smattering. I like that word, smattering, splattering, smattering. Smattering amount of peer-to-peer lending. Couple of announcements. We're going to talk about stock market stuff. We're going to talk about some Vanguard stuff today also. Some things. I've been getting some messages about Vanguard this last couple of weeks about bonds and whether I think the bond market is somewhere to put money into, because there's been some chit-chatter about bonds potentially being more of a safe haven to put money since we can see what's going on in the stock market. However, we're going to get to that. And we're going to do a little bit of trading 212 activity today because I think it might be time for me personally to have a little bit of a toe dip back into some equities, very short term probably, as potentially keeping an eye on what's going on in the financial markets. Big news in the UK, of course, today about the Prime Minister resignation. Crazy what's going on with that. You can see the real star of the show in the background. I didn't look to see how much the Great British Pound had taken a hit today or not. It doesn't seem like it really moved that much. I was expecting maybe the pound to get stronger today. It's a little bit stronger. Well, it's dipping up to 1.13 to the US dollar. But interesting news. It seems like the prime ministerial position is not such a stable place to be. And I did see something about maybe Boris Johnson coming back in as prime minister, which absolutely blows my mind. Anyway, a couple of announcements, because I know you came here for more interesting stuff than talking about Liz Truss. But first of all, please hit that thumbs up if you can. Appreciate that. Subscribe to the channel. 2 weeks' time. Put it on your calendar. It is going to be, what date is that? The November. Hang on. Let me look on the calendar here. November 3rd. We're going to have Louis Schwartz here from Loanpad. As you know, big friend of the channel, CEO of Loanpad, is going to be here with an update of what's going on with Loanpad, and generally we're going to have a peer-to-peer lending chat with him. So put that on your calendar. Don't miss it. And then also in January, mid-January, we're going to have a couple of representatives, possibly the CEO, depending on what's going on in his schedule, but the CEO of Folk to Folk, which is not really a it's not a company that I talk to about very much on the stream, but something that I've been kind of delving into, and they look somewhat interesting as a possible place to put money. Oh, let me turn this off here. So, yeah, January, I believe 19, so 2013. Is that right? Yep, January 19th. So tentatively put that in your calendar. November 3rd, Loanpad. January 19th, Folk to Folk. And who else in between? I don't know. We'll see. We're still working. I am still working. The dog is still working on getting some other guests here on the stream. So if there's anybody you want to see, come on here, put it in the comment chat, and I will see what I can do to get them here onto the stream live so we can ask them a bunch of interesting questions about their business. Quick hi to everybody. Peter Vince is a distinctly damp gentleman today in Leatherhead, and a woof to Harley. Yes, she is doing her usual whatever she does right back there. She's been getting very healthy these days, and I've been taking her on very long walks in the morning. But anyway, Alan Toombs, sunning Basingstoke. Hi, evening to you. Colin Perry in the Peak District. J.M. Roberts in Toronto. Good evening to you. Hi, Mark Mason. Nice to see you. Paul Bagworth, of course, in Kenilworth. Alan Stratford in a damp Worcestershire. Is that home of the Worcestershire sauce? Aki Chap, of course, Accrington, Mike Powell, Dave Dawson, Paul Bagworth is getting excited over here. Only 2 prime ministers until Christmas. That's pretty funny. Greetings from Nottingham, John Day, or it's raining. Yeah, we actually had one of those rare days where it was colder here in Florida than it was in the UK, which was yesterday. It got down to about 9 degrees, something like that. So you were lucky to be in a warmer place in the UK than possibly here in what is supposed to be sunny and hot Florida. Anyway, let's go to the news. Here we go. Put that up. Capital Rise hits £200 million in an origination milestone. So another one of these peer-to-peer lending companies. Oh, and by the way, if you haven't seen my sit down with the CEO of Capital Rise, it is on the Financial Thing YouTube channel. Just search. Her name is Yuma, UMA, and there was a pretty good chat interview that I had with her when they were doing a Capital Rise event in London. I was invited to attend, and then we had a sit-down chat. Pretty interesting interview there, so go look at that. But Capital Rise has originated more than £200 million since inception, and they have funded developments across London because they do tend to stick towards the London real estate market, and home counties valued at over £640 million. They've originated $100 million during the months to the end of June 2022, which has been a 252% increase year on year. The firm has said that it will continue to diversify and deepen its funding lines while investing in the expansion of their team. That's pretty good. They've been going since 2016, so good to see that they are still writing business. I wanted to go in and kind of take a look at their website because Capital Rise is not a company that I've personally invested through, but they've got 35 repaid deals, and these are not small deals. You see here 6.4 million, 5.1 million, 2.2 million, 2.4 million. So they are definitely going towards those higher end developments in London, which do tend to pay pretty good on the rates of return that you can get. Live right now, let's see, I just wanted to take a look at maybe one of these products. Let me log in here. I don't want to show you my password because who knows what you guys might do with that, but let's have a look and log in. I might have to take one of those. Yeah, you can see here. I got to take one of those tests because I have not. You know what? Let's just take it. Let's see how difficult this is. Maybe I'll get it wrong. Do I consider myself an experienced investor in unlisted securities? Why, yes. If I lost capital on a small number of investments, could I afford my current lifestyle? Probably not, but I'll put yes. Actually, no, I'll put yes. Are you prepared to invest in bonds that are estimated term between 1 and 2 years without knowing that exit is guaranteed early? Yes, I am. Do I want to take risk in high-risk investments? Have I experienced or anticipate an event that will make your financial circumstances unstable? Hopefully not. Do I feel pressurized to invest at this time? No. Are there any other circumstances you think we ought to know? No. Let's go ahead and see if we can get through this. Congratulations. Now I can make investments at any time. See what they have on the upcoming investments. If any of you out there invest in Capital Rise, let me know. Let me know what your experience is like. Forecast annual return 7.15 to 7.4%, 24 months. LTV 68%, first legal charge. So it's a bond. You got £1,000 minimum investment. You can use an ISA for tax-free returns. So the question is it worth 7% for the risk that's involved? That's always the tricky thing, trying to equate risk versus reward in these investments. Let's see if they have anything on the resale market. So it seems to be around 7%, not really. £1,000, £1,500. I mean, look at these places. They're very, very high end. There is some stuff on the secondary market if you're looking for a place to put money. But yeah, you're going to need to put in those minimums. So interesting. I do think that I actually had a really good feeling when I sat down with Uma of Capital Rise. It seemed like they really know what they're doing. As far as I can tell, again, not financial advice. These are expensive investments as far as their locations. At first, when I first sat down and talked to her, I thought, it's the London market, man. That is really a tough place to be completely diversified just into London. I thought, what is the risk of that? Should that property market continue to go down, because the London market was under a lot of pressure? But it seems like Capital Rise has really found a way to make that work, as 35 repaid loans have happened since 2016. So is that 6 years? What are we talking? 5, 6 is the 30, about 6 loans a year, 6.5 loans a year, but big loans. So interesting. Ooh, look at that. That's a spiffy garden in Chelsea. Very nice. Anyway, move on. Brick owner restructures secondary market. Again, not really a company I know. I think we had a brick owner rep very early on, maybe 2 or 3 years ago, Fred, I believe. So if you go back into the archives of the Financial Thing videos, you'll see an interview with Fred. I think it's Fred Bristol. They have restructured their secondary market to allow people to add discounts and premiums on secondary markets, so become more like a trading market. And it's been tabled at the moment while it's being redeveloped. I wonder if the FCA is going to take a look at that and say, good or bad. But I can't, I'm not a big fan of secondary markets that allow people to add discounts. Add premiums. I like discounts, but I think premiums can really slow down the secondary market on these platforms. So I've always been a proponent of having just discounts and no premiums. I believe Assets Capital does that. So Bricker is changing their secondary market. Easy Money has scrapped their bottom rate product, the one that was 3.08%. And now they have only the plus 4% product and above. So that would be the target rate. It says the decision has come as cost of living crisis takes hold in the UK, hitting those with little to no savings the hardest. Jason Ferrando, chief executive of Easy Money, said the team had many discussions of what it could do to help. Decided that removing the lowest return account was the right one. The change means everyone's target rate with less than 10,000 has increased by 0.95 percentage points. So I think that's a really good move for them. So you can see here now, and obviously, I mean, they really needed to do this, because if you can get now, I got an email, let's see, this came in the other day, a couple of days ago, that Ford Money has increased their base rate from 1.93% gross to 2.47%. So if you want to get yourself a decent savings amount, now you can get 2.47 with Ford Money, and also a myriad of different banks, which makes, a 3.08% in peer-to-peer lending now seems just not really feasible at this point. And you only need £100 minimum to get this 4% rate, which is, I think, very, very attractive. Once you have 20,000 plus, and you can move up to this 5.02% and £100,000 for you high net worth people over there at 6.01% target rate per year. So I think they had to get rid of this 3.08%. It doesn't make any sense. Nobody is going to take 3% in peer-to-peer lending when they can get 2.47 in a bank. Octopus Choice, they went back into being profitable as they prepare for liquidation in 2023. As you know, I was a big Octopus Choice fan. I was disappointed that they decided to close their doors. They registered a pre-tax profit of £1 million in the year to 30th of April 2022 as the platform prepares for liquidation into the new year of 2023. Says the return to profitability was attributed to several significant loan exit fees being received by the company in the process of winding down operations as more loans were redeemed from the Choice platform. Now, assets under management shrunk from 93 million to 7.3 million. Rest in peace, Octopus Choice. Completely disappointed that they decided to close. See what the website looks like right now. The Octopus Choice platform is now switched off and can no longer be accessed. So I guess you can't log in and get your forms. They had some decent interest rates. 2021, our average interest rate was 6.15%. Looks pretty healthy. As you know, Octopus Choice is a part of a very big group of companies, and they obviously decided that the Octopus Group decided Octopus Choice was not going to be a feasible business moving forward, so they unfortunately closed it down. Rebuilding Society lenders record a profit in September 2022. Not a big one, but they've recorded a net profit for lenders of $21,859 for lenders in September, recovering from a loss of £43,795 in August. Platform received nearly $750,000 in capital repayments. Not really sure what is going on at Rebuilding Society. From what I'd heard, they haven't really been doing much lending there, which always is a reason to kind of look at things and say, why is a peer-to-peer company not lending? But, you know, anytime I guess lenders have technically net profits, that's a good result. And then the peer-to-peer finance news, where I do read a lot of these news articles from, has a short list. So they are doing an award ceremony. This is going to be the first time they're doing it. The peer-to-peer finance awards. I was just scrolling through and looking at who's on this list. For consumer lenders, we've got the Money Platform and Plend. There really isn't that many categories available, that many companies that do consumer lending now, since Zoper and some of those lending works and people like that have gotten out of the business. But shortlisted, I mean, some of the companies we talk about here: Assets Capital, Folk to Folk, Archover, Lending Crowd, and HNW Lending and Rebuilding Society. Property development lender, we got Crowd Property Assets Capital Investment Fund, Kuflink, Relendex, Crowd with Us, Bridging Lender, Crowd Property, Kuflink, Somo, Investment Fund, and Landlord Invest. Yeah, I mean, pretty standard stuff. But one thing I noticed on here, well, we have Assets Exchange here as a buy-to-let lender. Ethical lender, Lendwise, Assets Exchange. There we go. Good job, Peter Reed. Rising Star, Planned, Lemwise, Shojin, Assets Exchange, Quadus, and the Money Platform. But I don't see Loanpad on this list. CEO of the Year, Stuart Law Narinda, Mike Briscoe, Luis Alexander. No Loanpad. Surprised. Oh, here we go. Loanpad makes it as the ISA provider. I'm not sure why they are not included on any of these other lists, because I think they should be, but I suppose maybe people didn't vote for them for some reason. But those will be announced, the winners, soon enough. You can find out who takes the cake for those awards. Interesting. Blend Network too, they put out some really good financial documents. Jan, CEO of Blend, comes from the investment side of things where he worked, I believe, for one of the big investment banks a long time ago, but he always likes to send out these newsletters which really highlights what's going on in the economy and highlights kind of where they look to invest and the different risks that they face. So I like reading these because it's a lot of interesting information. It says we have managed development risk very well. Blend has. In development finance, there are two risk types. The first risk is the development risk, the risk of the property developer not being able to deliver the project within the time frame or the quality standards. Over the last 12 to 18 months, this risk has mainly emanated from the rising cost of materials and higher build costs. This is a big problem in the building world that builders start a project and then find that the rising cost of materials and labor has increased dramatically. So then they have to raise the prices, and that's really been a big issue because of this supply chain issue that's been happening since the vid. However, our hands-on monitoring of the loan book, solution-focused approach to lending, a proactive attitude has seen us go out of our way to find solutions. This has meant we've been able to manage this risk well. In some cases, we've had to ask the developer to inject more equity in order to cover high build costs. In some cases, we've arranged for them to get a second charge loan ranked behind our facility. Our solution approach has been well received. And then they're doing things to mitigate exit risk. The risk of the property developer not being able to sell or refinance at the expected value. That's what an exit risk is. One key metric that we consider when deciding to lend is the loan to value, obviously something we talk about a lot here, and the liquidity of the underlying assets. So meaning, can Blend or the developer actually sell what they've built or what Blend has invested into, should they need to sell quickly or even at retail in order to pay off the loan or refinance it. For example, on a standard loan to value at 65%, including the interest reserve, our net capital is around 60%. Furthermore, Blend's focus on small-sized projects means that our investors are well protected, or are more protected in a market downturn. Not totally protected, but more protected. For example, on a 10-unit scheme, we are de-risked when the developer sells 3 units. We are fully repaid when he sells 7 units. We believe senior debt is a much greater opportunity for investors compared to the equity in the current market environment. I like these reports because it's very much different to things that other peer-to-peer lenders send their investors. It's more of an in-depth look at what they're doing behind the scenes to really mitigate risk and provide good returns. You can see here, this is another document that Blend sent out a while ago, and it they're always talking about things like yield curves, which is how much yield you can get from particular investments. Talking about the worsening economic outlook, something I've been speaking a lot about, saying how stocks have been declining. They got some interesting charts on here about equity returns. You can see the S&P 500, when they wrote this, was year to date minus 13%, and quarter 2 2022 down 16%. The FTSE actually having the best results out of all of the equity indexes that Blend writes on here, at only down 5% quarter 2 of 2022, and actually was up 2% Q1 of 2022. But it's very interesting because if we look at investing money and we think, well, peer-to-peer lending, is it a quote unquote safe place to put money? Well, you can look at the equity markets and say, if the NASDAQ is down 22% or the FTSE's down 5%, and that's just in a quarter. Look at this, the MSCI World Index down 16%. You'd probably be feeling pretty happy about, if you're in an investment like Loanpad, where people bemoan and say, well, I'm only getting 4% return. Well, 4% definitely looks a lot better than the NASDAQ being down minus 22 in the quarter. And there's been a lot of talk about, historical returns in stocks investing. You know, and I say this too, I've always looked at historical charts and thought, historically, we would presume that certain markets will go up by a certain amount of percent over a long period of time. But what if this were not to be true anymore, even if it was for the next decade? And there has been a lot of articles around possibly a lost decade of stock investing. Here's one in the Motley Fool that says, here's why there won't be another lost decade. And then Forbes has an article that just came out today, is the stock market in for 3 lost decades, and the stock market entering its dangerous TARA regime, which means there are reasonable alternatives. We talk about TINA, there is no alternative. Well, now there's a TARA, there are other reasonable alternatives, and they talk in this article about bonds. And then we have another article investing in another lost decade, 2020 to 2030. So this article says the decades of the 2020s is likely to be another lost decade for the S&P 500, which makes a good case for things like, you know, you being able to get 3-4% target rate annually in a place like Easy Money or Loanpad. It's quite a compelling argument, because if we think that the stock market has a reasonable chance of doing basically a sideways motion or a negative motion, because we do expect with what's going on in the economies for there to be a stock market correction at some point, even though we've already considered to be in a bear market. But personally, I don't think the worst has been seen yet. There is a compelling reason to start diversifying into things like these maybe considered safer peer-to-peer lending companies, and to have that just as a diversification play. You know, if we look at let's look at the FTSE 100. Say, wow, what is a lost decade? You see a period of time here where we saw this peak of 1999 before the dot-com bubble, when everything just went haywire, and we saw 7 years to here, and we still didn't get back to this 69.43 time. It took until June of 2015, so we had essentially 15 years of lost returns in the FTSE 100. And if we look from here, this was the 2007, right before the financial crisis, to 2015. That was 7 years of loss. 7 years actually just trying to get back to where we were in the FTSE. So it's very possible that we could have certainly a lost decade. We don't really know. Same with the S&P 500. We've had these periods here, again, the dot-com bubble in July of 2000, where it took 7 years for us to get back to that same region in where the S&P 500 stood. Then we saw another fall back here, and again, it took another 7 years to get back to here. Of course, we had this huge bull run since 2010, which is highly unusual. So that's a 12-year bull run, well, considered bear here. But I think this lost decade is very, very much a possibility. And, you know, this is one of the reasons why doing things like trying to find sector-specific stocks, even though, yes, there is risk, you know, like going into energy when we're having an oil boom right now. And you start to look at things like that. But also, another thing I've been asked about is bonds. And are bonds a place that could potentially be somewhere you could rotate out from equities into bonds? Well, I was looking at the old Vanguard, one of my favorite sites, to see what the possibilities were. And I've been hearing a lot of things about, you know, investing in different markets overseas, like international funds, and also investment grade bond index funds, because one of these articles, I think it was from Forbes, was talking about investing in investment grade bonds. You can see Goldman Sachs talks about that in this article, saying that you could get some pretty good yield returns and investment grade bonds. So I thought, well, let me go look. Let's have a look at this UK short-term investment grade bond index fund. And here's the problem. So the risk factor on these bond funds is definitely lower because we see a 3 out of 7. And the charges are very low. But the problem is this. You see the yields here are just terrible. 1.4% gross. I mean, why would you do that when you can go and get 2.4% in a savings account? And then on top of that, the issue is this. You can look at the historical prices. They fluctuate. So if we look at a 12-month, we've seen here this bond fund go from £116 to where we are right now is 105. So it's lost 10%, 10, 11, 12% of its value. In the last 3 months, we've seen it go from 110 down to 105, so it's lost 5% of its value. So you do have some volatility in these investment grade bond index funds. And when I was looking around, I couldn't really see any bond funds that were even remotely interesting. You could look at even Japan as a place to put money, and they're paying 0.2% as a yield. So, and you can see here also these big price drops. It's gone from 113 down to 110 since August. So you've lost 3%. You're only getting 0.2%. Now, if the stock market were to correct, I think this is the first time that we've seen bonds not really correlating with equities. So usually when equities are struggling, bonds do really well, but we haven't seen that. We've seen an environment where bonds have just kind of been sucking the same way that equities have. So what about a global corporate bond fund? What can we get yield out of that? 1.46%. And again, we've seen, look, 0.35% loss today. Just not really looking attractive. Been falling in price. Is it safe? I would argue no. I would argue that this is not a particularly safe place to put money because you're losing money and you are also getting a very poorly low yield of just 1.46%. If this yield is 4, 5, 6%, yes, it would be worth taking that risk. But obviously there is risk involved in these bond funds. This is the reason why I sold my bond funds about, I don't know, a year ago. Probably way too late. Should have been done a long time ago. I just didn't feel like there was really much advantage in holding bonds, and I still don't see it at the moment. Could it be possible that could change? Yes, but again, who knows? Not so sure. Let's see what else. Let's take a quick look at the trading 212 portfolio because I think I'm gonna have a little dip back in here. Let's see. We've got 19,111 is the portfolio value. I'm just going to have a little dip into a couple of stocks that I think might be, again, please don't do what I do. This is purely for fun on my end, even though I, yes, obviously have researched these stocks. What are we going to go back into? We're going to put a little bit more into some, see, here's the one thing. I do not like doing it on green days. So we're up 2% today. I try to buy on red days. Arch is on a red day, but don't really want to put too much more into that at the moment. Flex, I'm happy to hold. Vermilion, so we're going to go ahead and buy Vermilion today since it's a bit of a flat day. So let's put in 500 there. Okay, and then also I'm going to do a little bit, something a little bit different. Live and direct. Deutsche Bank. Can we even buy that? We cannot because the market is closed. I wanted to buy some Deutsche Bank shares. Can't do that right now because the market's closed. So probably do that tomorrow. Just going to look at some Norwegian cruise line. Probably do this again. That's gone up a lot in the last, let's see, last week, 12.96 to 14. So that's about 9-10%. That's another one that I think I'm going to dip in. Yeah, we're up 10% in a week. Waiting for a bit of a pullback on that. And what else? Disney. The Walt Disney stock is just really taking a hammering. So up 2.2% last week. If you look at Disney, it's just 124 down to 98. I mean, this stock is from 176 down to 98. Do they pay a dividend? Not so sure, but that was one too that I've been keeping an eye on. We're going to bang in a little bit into Disney today. Let's see here. Let's pick up 500 Disney. Bang, bang. I never thought I would own Disney stock, but it does look like there's some value there. Okay, so we get a little bit more invested. I'll probably do some more when I see a red day, but really keeping a very watchful eye over these markets. Even Bitcoin. I mean, those who've said, Bitcoin. Well, Bitcoin's actually performed better than some markets over the last month, really kind of holding steady from 19,000. We did see it come up to 20,200, but it's been super volatile at 19,056. So really sort of doing a sideways thing at the moment. I don't know about the FTSE 100 either. You've seen these big pullbacks from 75 down to 6,900. Again, not really a big fan of the FTSE and being in that index, so tending to stay away from there. But there's not really much of a play, I don't think, in the bond market at the moment. Again, I think that could change. Cash is looking not like a bad place to be at them, and just kind of picking opportunities also. And then some of these peer-to-peer lending. Let's take a look at what Loanpad is up to. Yeah, I got to tell you, this rate right here at 3.2 is not looking at all favorable. From 2.47 in the bank to 3.2. I love Loanpad, but no, not where I'd be putting my money. 4.4, yeah, the 60-day. That is going to be increasing soon. I think they're going to have to make this classic account a lot more competitive because, yeah, people are just going to go to the bank versus this rate. And I think we had UK inflation numbers too that came out. Let's see, they came out yesterday, I think. Let's see what's going on. Let's see what the government has to say about UK inflation. This is, and I knew these numbers were not going to be good. Consumer price index rose by 8.6% 12 months to August, down from 8.8% in July. Didn't we get September numbers? I thought we got September numbers. Hang on. There we go. Yeah, this was why is it so difficult to find on this website? 8.8% anyway, September 2022. It's not looking good. These interest rate hikes are not working, at least not yet. We got 8.8% CPI inflation in the UK, September 2022. Got these obviously squeezes on electricity, food prices are going up. The CPI index rose by 10.1% in the 12 months to September 2022. So that does not include occupiers' housing costs, the CPIH. So if you take the CPIH out, you're looking at 10.1% inflation. This is a big problem. I don't know. It kind of seems like in the UK that things are just in turmoil, especially now with the Prime Minister situation going from bad to worse. These rising inflation numbers, increasing interest rates. This is not quelling the inflation. Or I personally, if I had to fix this, I could think of only one solution, and that's that banks would have to hold reserves in cash. You know, we got this idea that banks now don't have to hold very much reserves in cash, so they can just lend out everything that's on deposit. So your money that you're putting in a savings account at 2.7 or 2.47, that bank can lend out practically most of that, if not all of it, out to other people, get a higher interest rate and pay you less. I really see maybe the solution is the government says you got to start holding more reserves in the bank. That way the banks can't lend out as much to people. People are not taking as many loans out. They're not spending as much. These consumer good prices don't rise as much. But I don't really see any other solution how the government's going to get around this inflation rate. It's not looking good. And this is why, again, I'm keeping a really close eye on the stock markets, because I just don't understand how these markets are continuing to stay afloat, even though, yes, technically bear market, but I would have thought by now we'd be seeing some signs of these markets really starting to take a hit. And my good friend who works on Wall Street said to me, Lawrence, he's like, I want to tell you something. As a trader myself, this is what he said to me. This whole stock market is all fugazi, which is Italian for fake. It's completely propped up. Nothing makes any sense. We had a great example of this on the 13th of October when the inflation numbers came out. And we saw the markets rally when the U.S. inflation numbers, you can see right here, the markets rallied that day, I think up a couple of percent when these inflation numbers were terrible. And it's just complete market manipulation at this point. I don't really have much faith in any fundamentals in markets. And if I woke up tomorrow and saw that the market had crashed 8 or 9%, it absolutely wouldn't surprise me at all. It's all fake. It's all propped up. It's all traders, governments propping up these markets. And there's another case for the whole thing about the bond market too. Just another thought before I wrap up this rambling, that if people did start coming out of stocks into bonds in large amounts, then that's another thing that could bring down the equity markets. But again, is that going to happen? I don't know. I think people are kind of delusional when it comes to stocks because they've been so used to these 12 years of bull market gains that they're looking at bonds as not a place to put money. So things don't change until things change. And one day it's going to change, but I don't know where my crystal ball is. It's completely lost. I think the dog ate it. So I have no idea what's going on in these markets anymore. So definitely doing everything with a short-term view in this Trading 212 account, especially just keeping an eye on things every single day, looking at the news and looking at the markets, being ready to pull that trigger when I see that maybe the poop is going to hit the fan. Anyway, if you're enjoying the content, please hit that thumbs up. And how long have we been going for? 49 minutes rambling. Again, be here 2 weeks' time. Louis Schwartz, CEO of Loanpad. I'm going to hound him about this 3% interest rate. Come on, Louis, you got to get that rate up. It's not going to cut it. See if you have any interesting comments. Patty is here in France. Bonjour. Another decent looking loan on Capital Rise again today. 7.5% for first charge. 40% loan to value. Gross development. Brick owner is not regulated. Okay, good to know. I'm looking for at least 7% now. Longer term property loans. Don't blame you at all. Again, I think, hard assets, things that we've historically looked at as losing value, maybe places you could put money. Maybe cars are going to go up in value like they have been. Who'd have thought, right, that cars would actually go up in value? And not just, exotic cars or collector's cars, anything. A lot of you saying that you like Blend. Yes, cash drag is a problem because Blend is super popular. It's hard to get invested into the loans sometimes. Double D, the dividend master, said he managed to buy some Legal in General at £2 and 4p the other day, which I felt was a great opportunity. You're a big fan, aren't you, of Legal in General? Let me look at Legal in General. I want to look at their charts. I know they pay a good dividend. Legal in General Group. £2, 30p. Dave, they're down 15.85% for the last year. Down 11% for the last month. That's okay, though. What do they pay? What's the dividend on Legal in General? I have no idea. We go back to 2013. It's gone up 32.9% through 9 years. But you do get a dividend. I don't know what that dividend is. But do look at the volatility of dividend paying stocks. You can see right here, 318 down to 156. So I'm presuming that was probably during the vid crash. So it lost half of its value, 50%. So dividend paying stocks, they can get hammered just like any other stock. Pay attention to that. I know a lot of people like dividend paying stocks, but somehow a lot of people misinformed that there is low volatility in dividend paying stocks. And you can see from here, that is absolutely not the case. 292 down to 177. I mean, what's the good of a dividend if your stock has lost 50% of its value? Yes, all stocks can be volatile like that for sure, but just keep that in mind. You can get 3% from HSBC if you don't make a withdrawal in a month. What does that mean? So like you can't touch your money for 1 month, or... Yeah. I should set some stop losses. What fun is that, though? I mean, come on. Stop losses? No, I understand. 3.2% Loanpad rises 3.6 on December 1st. Still a little low. Aki's got a French car. Is that a Peugeot? Or a Citroën? That's gone up in value. What's the world coming to? I tell you, the world is coming to what we may have not seen before. Everything looks different. Yeah, Legal in General, you buy them cheap, hold them. Yeah, I understand. I get it. Just there is volatility that comes with dividend paying stocks. Anyway, on that note, it's time to go. I'm sure you've heard enough. Hope you enjoyed this stream. Thank you very much to every single one of you who supported this channel by coming and watching, sharing it with people, subscribing, being a Patreon member. Very, very much appreciate it. And I'm going to be heading over to the UK in December. Maybe I'll do a meetup. Who knows? Probably not. Maybe. But I'll be in London town in December around the holiday period. So you guys have a wonderful evening. Have a great weekend. And I will see you next time. Don't forget, 2 weeks, November 3rd. All being well, Louis will be here from Loanpad Live. So tell everybody you know about it. Share it. Come enjoy the stream. Come armed with your questions for Louis. He likes questions. And we'll see you next time. Take care.